Hello. So my recent videos have been very successful. As an example, Baidu this morning was a double on a strangle. So today I'm going to look at a strategy that paid off really well yesterday, which is a risk reversal. Now I did this on Twitter, bought the stock and bought puts, and after hours the stock skyrocketed up, so I was able to sell my shares for a nice gain, and then the stock pulled back, so tomorrow my puts will also have some value. So I'm going to do the same strategy here with Facebook, ideally hoping for something along the same lines. So I'm going to buy 200 shares of the stock, and the closing price was 95.29. We'll see where it opens tomorrow, but that'll cost me about $20,000. Then I'm going to buy puts at the $99 strike, and right now that would cost me about $6.40 each. So for two puts, that would be a cost of about $1,300. So the total cost is going to be $20,000, $350.48. Now that is expensive, but remember we're just holding it for one day. So you can do this with margin if you have a big enough account. If you don't, maybe you only want to do one contract and 100 shares of Facebook. Now with this strike price and premium, my max loss is just under $560. So if Facebook is under $99 at the expiry, I would lose about $560. However, as long as Facebook doesn't plummet, I can sell my Facebook stock and sell my puts with a little bit of time value left. So odds are I won't take much of a loss on this one, even worst case scenario. Now on the upside, the break even is about 101.80, 101.79, depending on your commissions. So if the stock gets to that after earnings, I've broken even, and anything above that, I have all of the upside. So I'm not risking much to get a lot of upside if Facebook reports well and moves over 6.82%. Now, best case scenario would probably be similar to what happened with Twitter. Facebook skyrockets after hours, so I can make a gain on the shares to cover all of my costs and still have some value left in the puts. So this is a risk reversal. It's a great way to play earnings with very, very little downside risk and unlimited potential upside. Okay, so I'm going to analyze my protective put strategies with Twitter and Facebook. So what happened with both stocks is they went up initially after hours when they reported. So with Twitter, stock went up above $40. I sold at $40.50. And then, as you probably know, the stock started plummeting. And the next day it opened around 32. So the put I had bought ended up being worth $7.60. So I sold the stock at a price that was able to cover all of my costs and give me a little bit of a profit while still holding the puts. The next day I sold the puts for a little bit more revenue, and in the end I actually made a profit of $1,600 or 20%, even though the stock went down on something that I had owned going into earnings. Same idea with Facebook, not quite to the same degree. So after hours, the stock went up. I sold at 97. It went a little bit higher than that. I think it may have even got into the 98s. But I sold at 97, knowing that it was starting to come back and fearing the same thing as Twitter. And sure enough, it did pull back the next day, opening a few dollars lower. So I was able to sell my puts for $7.25. So again, I made a small gain, this time only $347.24 for a little under 2%. But that's on a stock that I already owned long going into earnings that dropped, and I was still able to make a profit. So that's the advantage of the protective put. Subscribe and share, and please follow me on Twitter, and you can add me on Facebook as well, Day Trade Canada, and visit the website. Thank you and happy trading.